I'm joined by Nick Timberlake. He's Global Head of Emerging Market Equities at HSBC. He joins us live from Singapore. Good to see you, Nick. So the world in emerging markets has changed significantly in the last few months as we've seen unrest spread throughout the Middle East, governments fall there, and investors pull their money out. How are you adjusting your strategy?
Yes, well, when we went into the crisis in the Middle East, we were well positioned, exposed to some of the cheaper markets in the emerging world, such as the Russian market, which is actually a significant beneficiary of rising oil prices. And although that market has rallied substantially and some of the Asian markets have now come back, we're starting to see value appearing in some of these Asian markets, and we think the market is acting in a very efficient way, discounting the more significant inflation risk and also the risk of additional demand destruction.
Have you pulled out any investments that you've had in the Middle East?
We haven't really got any exposure in the Middle Eastern markets today. We have taken some profits in our Russian exposure over the last few weeks, really to help fund some of these more attractive investment opportunities that have been occurring in the Asian markets. But the Middle East is not really an area where we have a huge amount of exposure in our funds.
All right, well, let's talk about those opportunities in Asia then. Which countries do you like the most at the moment?
Well, we're starting to warm up to the Indian market. The Indian market's fallen nearly 20% since its highs last October. And although we're not super bullish on that market yet, it's definitely starting to look more interesting. I think China also, which has been a market that's lagged many other emerging markets over the last 18 months or so, there is some value starting to appear there in sectors such as the banking sector, for instance.
What governs your investment decisions when you look at India and China? Which sectors are you looking to based on your strategy?
We're very focused on valuations and the returns that the companies are generating. And what we see is that actually returns are holding up reasonably well in this environment, despite the additional inflation. Obviously, with the prices having come down, the valuations are now looking much more attractive. Financial stocks in general are some of the stocks that have been hit the hardest and therefore are starting to look more attractive.
This is, though, Nick, a very difficult environment. I mean, 2011 has its own set of challenges. We have higher commodity prices. You've now had a spike in oil prices. Are you very concerned about the impact of inflation?
I'm sure there's going to be more volatility this year, and I'm sure the inflation problem is not going to go away. Whether or not we've seen a peak in inflation or that peak comes later in the summer, I think there's a lot of different debate and views out there. I think the central bankers in Asia are doing a good job of reacting to the inflationary problems as they've occurred. And yes, we are going to see more volatility, but I don't see any reason why we shouldn't expect markets to rise higher this year. We're still in an environment where valuations are reasonably attractive. Growth in the world is synchronized today, and we see that feeding through to profits numbers. So yes, inflation is definitely the key risk, but I don't think it completely spoils the party.
And what about the risk to the global economy of this spike in oil prices? Are you concerned that we could see a slowdown?
Well, you just had a clip on with the chairman of the Federal Reserve talking about the impact of higher oil prices on economic activity. There's no doubt that as prices rise from here, we're moving into a territory where demand destruction will exist. So we have to see how far the prices move. And if we see a substantial spike up, then that would be more concerning. As things stand today, I think we still see economic recovery coming through.
All right, Nick, let's reassess your outlook in a couple of months. Thanks, Nick.